Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, November 25th. The market has been riding a nice vibe since two sessions as December Fed rate cut expectations surge past 80%. But every comment from the Fed bankers now carries outsized influence and opinions diverge. So short-term yields are swinging, risk assets are reacting sharply, and investors are straddling hope and caution. The backdrop, on the other hand, remains a weakening jobs market in the US, inflation still above the Fed's target, and the lingering uncertainty from tariffs, a mix that keeps the outlook anything but clear. So traders are scanning every word for hints, weighing the odds of what comes next, especially from the Fed. So here are three possible year-end scenarios depending on what the Fed will or will not do. But before we move on, please keep in mind that opinions are my own and this is not financial advice. So Friday's rebound was thanks to the New York Fed President John Williams, who, in the middle of a less dovish Fed crowd, said that the Fed could lower the interest rates in the near term. Near term being December, of course. So we talk about how that comment flipped the expectation of a December rate cut from the Fed from below 30% to above 70% in just one trading session. And yesterday's 1.5% rally in the S&P 500 that particularly revived the technology stocks and triggered a 2.62% rally in Nasdaq 100 was fueled by the Fed's Christopher Waller, who called for a December rate cut yesterday to support the weakening US jobs market. Then we should take a meeting-by-meeting approach, the man said. Then San Francisco Fed's Mary Daly also echoed similar support for a December rate cut on Monday. So the winds have turned very quickly indeed since last week. The US 2-year yield that best captures the Fed expectations slipped below the 3.5% level this morning for the very first time since the 29th of October, after the Fed had cut the interest rates by 25 basis points. Remember, but Jerome Powell had warned investors that the December rate cut was not a done deal. So what changed since then? Well, nothing much really. Or maybe things have changed, but we don't know toward what direction, because a few days after the latest Fed decision, the US government shut down and remained shut for more than a month, and the data flow, especially the official data flow, just stopped until last week. Then last week, the September NFP data pointed that the US economy added 120,000 new non-farm jobs before the shutdown. But wages growth slowed and the unemployment rate rose to 4.4%. And we didn't yet see the color of the inflation report just yet, and we will reportedly not get the CPI data before the week after the Federal Reserve's December meeting. So we are left to guess. We know that the US jobs data is weakening, but we don't know if inflation is heating up. We know that subdued energy prices certainly keep inflation in check, but we don't know how much it could counter the tariff impact on consumer prices. And we know that the latest CPI printed an inflation rate of 3% in the US that is significantly higher than the Fed's 2% target, and we keep believing that inflation in the US could eventually rise someday due to these tariffs, now that the pre-tariff stocks have been sold out, and the companies in the US may need to pass at least a part of the tariff-led cost onto their clients. So in this jungle of possibilities and data and happenings, I see three possible Fed scenarios for December and end of the year. One, the Fed refrains from cutting the interest rates and waits for the inflation data to make sure that they're not cutting on hope but on fact. So the short-term yields react by rebounding, the risk investors get upset, and the following data, especially the CPI data, shapes the expectations for January, with a good chance to see the rate cut only kick down the road from the Fed. Two, the Fed cuts the interest rates in December and the CPI data comes in line or ideally softer than expected the week after, with hints of no tariff-led inflation whatsoever. Then the bulls rush in, the stress about the technology valuations and accounting rules that don't add up fly out of the window. Santa arrives full of gifts and the party could go on. And 3, the Fed cuts the interest rates in December and the CPI data comes in hotter than expected the week after. And the idea that the Fed should walk back the latest rate cut injects high stress and high volatility into the market before the year ends, and we see a 10 to 15% sell-off in the S&P 500 as hopes for further rate cuts from the Fed next year vanish. Now, I can't tell you what's on the menu of this Christmas, obviously, but the probability of a December rate cut just spiked past 80% over the past 2 sessions, again from below 30%. And the last time we saw the Fed rate expectations change this fast, that was September 2024. Remember, a last-minute decision, which was to cut interest rates by 50 basis points. Well, happened to be a mistake, and the Fed had to pause for a year before moving again. Did it prevent the bulls from buying? Not really. But anyway, it's always fun to watch the economic data. So today, the US will reveal its latest PPI and retail sales data. Last week's results from big US retailers actually suggested that the consumer in the US isn't cracking, but is clearly tightening the purse strings as higher prices and borrowing costs bite. So the retail sales may have slowed in September, which is good for those praying for that 25 basis point cut from the Fed, and the producer prices may have accelerated on a monthly basis, but slowed on a yearly basis, which would be mixed enough to give the market and investors the flexibility to focus on the metric that they want to. But given that the data is now telling a story of the past, what the Fed members say today are more important to investors than what the data prints. So for now, investors continue to bank on another 25 basis point cut from the Fed in December, and that's positive for risk sentiment. As such, US futures are, well, they're not in the positive this morning. They are flat to slightly negative. Maybe the 10% drop that we saw in SoftBank shares this morning on fear that the company may have bet on the wrong horse, that would be OpenAI and Nvidia, is weighing on sentiment following the news that Alibaba's Qwen 3, for example, counted more than 10 million downloads in its first week. And Google's latest Gemini 3 has been cheered for its impressive progress into 3D reasoning and agentic and vibe coding. But whatever happens in the market, Google looks like it will continue to rally as is 2023 again. In the FX space, the US dollar seems as confused as I do faced with the quick change in Fed expectations. It looks very dodgy since the spike past its 200-day moving average last week. It has not been willing to make a move below this level despite the softening Fed expectations. Also because some of the majors like the Japanese yen and sterling look massively unappetizing right now probably. So for the Japanese yen, the expectation is that the Bank of Japan will hardly hike the interest rates in the coming meeting, as Takaichi there doesn't want it to hike the interest rates. And more importantly, the JGB yields have spiked to levels that are not worth taking the risk of a rate hike, not right now. And for sterling, tomorrow's budget is make or break day. Either the Bank of England steps in to prevent a gilt flare-up if investors dislike what they hear from Rachel Reeves, or to cushion the economy if tax hikes bite hard. Either way, the Fed will be saying the last word, ladies and gentlemen, but the dovish shift in other central bank stances could soften any renewed weakness in the greenback before the year ends. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.